Hello, hello. So, are you being bombarded with some really scary questions regarding mortgage rates, what's happening in the real estate market? Well, today I'm going to do sort of a deep dive with Sebastian Rivera of Intercoastal Mortgage. He's the senior vice president at Intercoastal, and I would like to welcome him.
Thank
Sebastian,
you.
good
Thank you.
morning.
Good morning. How are you?
I am great, thank you. So I wanted to start off with a couple of questions. The first one regarding interest rates. With interest rates still fluctuating, how are you advising buyers who are concerned about locking in a rate too soon or too late? What's your take on that?
So, mortgage rates are on a downward path. A lot of people are concerned, well, I always want to lock at the lowest point. Give me the lowest point. Well, mortgage rates are going like this, slowly but surely down. Fannie and Freddie are expecting rates to be about 6.1 to 6.2 by the end of the year, and next year to go into the high fives. So, regardless of what you're locking in right now, 6.7 or 6.8, you're still going to be refinancing in the next 12 to 24 months. So, my suggestion there is whenever we're locking in, take that as your interest rate for the next 24 months and not for the next 30 years. So, once you look at the difference of what that's going to be, it's not a whole lot, really.
Right. And at the end of the day, we tend to forget that there is a possibility of renegotiating in the future.
And that's the goal. Refinancing once rates come down and you're in a favorable position. One of the most common questions I get is, well, how much should rates come down? At a bare minimum, it's 0.5%, but usually we like it to be 3/4 or a full percent to make sure you get the most bang for your buck.
Okay, cool. So question number two is many sellers are rate locked into their current mortgages under 4%. How is this impacting inventory levels, and are you seeing any creative financing strategies helping to get those homeowners off the fence?
Massively, absolutely. Before COVID, I would have clients say, oh, well, we have this rate, it's 5%. We're going to sell that property, grab all the equity, go into the new property. We just want to get it sold, either before closing or after closing. What's happening now is people are saying, hey, you got me this great rate. I got a 2% 30-year fixed rate. I don't want to get rid of it. I have a 2.5. I have something under 3. So the incentive is to keep that property, rent it out, and purchase another one. So on the new purchases, we're seeing a higher demand for ARMs, which are 30-year mortgages with shorter fixed terms that have lower interest rates. Yeah, we're starting to see a couple of creative ways to do those, and also buy downs. Buy down is basically buying down the interest rate for a specific period of time. For example, the most common one is a 2-1 buy down. For the on year number one, you buy the interest rate down 2%. Year number two, it buys it down 1%, and year number three, it reverts to whatever it was. If we're expecting lower rates in the next 2 years, it's a great product to consider.
Okay, can you go into a little bit about a definition of what ARMs are? Because I feel
Of
that
course.
we live in a world of 30-year fixed, and ARMs is something that a lot of people are not familiar with.
Yeah, of course. So a 30-year fix is easy. It's a mortgage fixed for 30 years. It's
Mhm.
amortized over 30 years and it's fixed for 30 years. Now, an ARM is a little bit different. It's amortized, so it's built over 30 years, but the fixed period is shorter. 5-year ARM, 7-year ARM, 10-year ARM are the common ones. 5-year ARM means that it's only fixed for the first 5 years. 7-year ARM means for the first 7 years. 10-year ARM for the first 10 years. So, for example, we're 2025 right now. If I give you a 5-year ARM at, call it 6%, for the first 5 years, that product will behave identical to a 30-year fixed mortgage. It's fixed for the first 5 years. Other ones for the first seven, for the first 10. And ARMs can sometimes get you better deals than a 30-year fix. So it's worth considering and exploring the product. There's some great ARM products out there.
Do you have the possibility of refinancing?
Anytime. There's no prepayment penalties. You can pay them off whenever you like. Whenever it makes sense, financial sense to do so, we can
Right.
refi.
Great. So affordability remains a top concern. Are you seeing any lender programs such as temporary buy downs, like you just mentioned, adjustable rate products, or first-time home buyer incentives gaining traction again in this high rate environment?
A lot of first-time buyer incentives. You see a lot of grants out there. We just closed the first front door grant, a $15,000 grant for those buyers that qualified.
Wow.
Have to have lower income, 80%, under 80% AMI, and it's very geographically restricted. But for those that qualified, it's a great program. You have 6 months to select your house. VHDA is still one of the top contenders, 100% financing, 101.5% financing.
Right.
Rates are a little bit higher. You have some programs that had subsidized interest rates. You have programs like Home Ready, Home Possible with Fannie Freddie.
Wow.
There's so many programs. So when somebody says, "Hey, what's the best program?" I'm like, well, it depends. It's like going into a dealership and saying, "What's the best car?" Well, depends what you need. Do you need a 4x4? Do you need a fast car? Do you need a commuter? Do you want electric? What color do you want? Do you want a 5 seat?
Right.
It depends. So there's a lot of products built for different reasons, and we need to make sure we get the most efficient one for whatever our buyers need.
Great. Great idea. So it's, yeah, so at the end of the day, there's a lot of work that you have to do with first-time home buyers to educate them on basically what it is that they want and what it is that they need and what it is that they can afford.
And sometimes we'll have an attorney coming and saying, like a brand new attorney saying, "Hey man, I just got my first job. I've been 3 months at the job. I'm getting $100,000. I have no money. This is my first house. I got like $5,000 saved up. What can I do?" I'm going to gear him toward a very different product than if I have somebody that says, "Hey, I have $100,000 saved up. I don't make as much money. For me, the down payment is not a problem, but monthly cash flow, it's a big problem." The new hotshot attorney is going to be making big bonuses at the end of the year, which is going to be a very different product than somebody that has limited income with limited growth.
Okay, good. So how are today's stricter underwriting standards impacting self-employed borrowers or those with non-traditional income sources? And what should these clients be doing now to prepare if they're looking into purchasing real estate?
Um, there, some of the underwriting guidelines have definitely gotten tougher. Others have just been always there. They're just enforced more now.
Okay,
So if you're self-employed and you've been self-employed for 5 or more years, Fannie Mae and Freddie Mac typically will allow us to get away with only 1 year tax returns, which is great. So if your 2023 was low, but 2024 you killed it and is doing great, and your business was established before 2020,
right,
guess what? You have to use 1 year returns. Standard guidelines typically want us to use 2 year returns. So
right.
we have some things that are changing and helping us out. We have other specialty products, such as, for example, if you're an investor and you write everything off, and on your tax returns you're making whatever $40,000, and you want to buy a $600,000 property, a DSCR loan is only going to look at the ratio of what your mortgage payment is going to be versus the perceived rent. And as long as we have a 1-to-1 ratio, so if your mortgage payment is 3,000 and you can rent it at 3,000, guess what? We can do a DSCR loan even though your income wouldn't qualify. We also have
Okay,
bank statement program loans. I'm actually working on two of those right now.
that is
Clients.
great. I wasn't aware of that. That is a good
Mhm.
program when working with investors. So now I want to move on to a little more general topic, which is let's talk a little bit about what you're seeing in terms of pricing in the real estate market. I hear a lot of noise about pricing coming down, and my theory has always been that after COVID or during COVID, where there's amazing scarcity, people tended to overprice their properties. And so whenever I see a reduction in price, I tell my clients that it's predominantly bringing down the price to fair market value because they were overpriced. What is your take on that? What are you seeing?
Yeah, I mean, if I were selling a property during COVID, I think my house is a Taj Mahal. I want to sell it for as much as I can. If I think it's worth 1 million, I'm going to try 1.1. I'm going to do it as high as I possibly can. I mean, it's
Right.
everybody wants top dollar, but what's happening right now is that we're seeing more realistic numbers come back into the market. I was browsing the other day on Instagram, and somebody said real estate is collapsing. Northern Virginia, everything is coming down. So during lunch break, I decided to go on the NVAR website. I pulled up all their stats. I went back 4 years and I looked at the actual list price versus sold price. And I did a chart on it, charting back 4 years. I did a social media post on it. And it just the numbers are clear. Every single year, the average prices are going higher. It's what we're seeing right now is a reduction of the rate of appreciation. So before we would appreciate 4%, 4.6%. Guess what? Right now we're appreciating 0.2%. But guess what? Still going up. It's just not appreciating as high. And Northern Virginia, all this DC area is, as you know, it's a little bit of a bubble and we love it. We're insulated to what happens in most of the country.
Yeah, contrary to expectations with all the governmental changes that are happening, I still see pricing of real estate go up. So I tell my clients, instead of gold, instead of, all these other commodities that you can purchase, bonds, stocks, etc., real estate is a much more secure and tends to, appreciate over time. Yes, I agree with you that the rate of appreciation has lowered, but you're still appreciating over time, so it's a good investment.
It's a great hedge against inflation, real estate. And it's not that saying you have to go all in on real estate, but it's a phenomenal hedge to have in one of the most secure markets in the country where there's always going to be jobs. And despite Doge going through and axing all these jobs, the demand is still there. I had a buyer I was helping on a $990,000 listing he wanted to buy, 17 offers. My
Yes.
client offered 10% higher, still didn't get it.
Yeah. I still see that. There's certain pockets, inventory has grown, for example, in the Potomac area. Inventory has grown significantly in DC, which was welcoming. The only place I see stagnation, my avatar is people basically 45 plus, 50 plus, and a lot of downsizers. And unfortunately, you can't say the same thing about the condo market. That's the only market that is really yeah, that hasn't appreciated in certain pockets like Bethesda, Chevy Chase, DC, etc. You don't see those rates of appreciation. So clients that, let's just say that they bought when they downsized a few years ago and want to move into Inspire or one of these 55 plus communities or assisted living, they're having trouble getting their money back. And properties, unfortunately, are sitting on the market too long. But I can't say that about single family homes even in areas like Potomac, where there's a significantly more inventory, or DC, you still see, multiple offers in many cases. And in other cases, you see what I call price improvements, which is going back to what I said initially. It's predominantly going to the market at fair market value.
And so
So,
there's still people trying to fish for value. I mean, I see it all the time. I have sellers as well that I see what they list their properties for, and their agent tells them, do not list it for this. And my client will tell me, oh, I'm going to list it for this. I think I can get it. 1 month passes. I'm like, nope, my agent was right.
right, right. That's why I always do. I always tell my sellers, I give them what I call a honeymoon period. So if they're adamant in getting their price, I put it on the market, and I always tell my clients, neither you nor I are going to decide what the value of your property is. The market will decide that for us. So you have 21 days. We can do whatever you want, and if by day 21 we don't have any results, then we will go back at fair market value, whatever that value is based on comps. So anyway, very well, Sebastian. This was a good session. I so appreciate, as usual, your intervention and your insight and all your experience. So I bid you goodbye, and I hope that we can get together again soon and talk to you soon.
Talk to you soon. Thanks for having me.